Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
Okay, everyone, welcome to the Smart Property Investment Show. It's Phil Tarrant here. Hopefully now that my voice is getting quite familiar, if you're a regular listener of the Smart Property Investment Show. If you're new, welcome. I hope you enjoy today. We're going to do something that we try to do every sort of month or so, a bit of a Q&A session. So it's important for us on the Smart Property Investment Show to just know what's going on, to understand your thoughts, your feelings, your sentiments towards property markets. And we want this to be an open forum. So we invite our listeners to get in touch and let us know any questions they have. And what I typically try and do is find someone who is a expert in this game to come and join me to run through them. So I've got three good questions in front of me today that we've received to the, a couple. One was via Twitter, Smart Property HQ, if that's how you want to send your stuff through. A lot of these do come from email, editor@smartpropertyinvestment.com.au. We get lots and lots of questions, so if we haven't got to your questions today, I do apologise, but we will do endeavour to get around to them at some point. But what I've done, I've looked at the ones which I think are going to be most relevant to our listeners, irrespective of where you are investing in Australia. To help me answer these today, I have Paul Glossop. Paul Glossop heads up Pure Property Investment. It's a buyer's agency. Paul, how you going? Welcome back.
Thanks for having me, Phil. I'm doing well, mate.
How's business, by the way? All right?
Busy.
Yeah.
As busy as we personally have ever been, for all the right reasons.
Yeah.
I think a lot of intelligent investors are probably seeing opportunities in certain markets, especially people who probably previously looked in markets such as parts of Sydney and to an extent parts of Melbourne, and I think they're starting to see some really good value opportunities across the country, and we're really got our finger on the pulse and really securing some amazing properties, which I think over the next 5-10 years are going to pay some very, very handsome dividends.
Okay, that's cool. What I might do is I want to pick your brain on some of the markets. I know that you're investing in Australia, but it's probably don't have enough time for it today. So let's get you back in about a week or so, and let's just do a bit of a freestyle chat about the way you've seen the world. And tune in, everyone. If you look, give it about a week or so. We'll make sure we let you know when it's out. But I'll get Paul back on, and we'll pick his brains and see what sort of intel we can get out of him, and hopefully can help you shape the where you're investing right now. But it's Q&A day, Paul. We've done this before.
Yep.
We'll run through these, and more so than not, these questions just pretty much give us a topic or a bit of a theme to chat around. And just for everyone, you know the drill. This is obviously myself and Paul, Smart Property Investment Show. We're not giving you any specific financial advice. It's just a general conversation around investing in property. Our recommendation is before you make any investment decision to speak with your relevant trained financial professional. Apologies for disclaimer, but I've got to do it. This is just us really giving you a bit of a yarn and understanding of what's going on, and hopefully some information can go away and get some use out of it. So first question, Paul, it says, hi Phil, that's me. I enjoy listening to your podcast and want to thank you for all of the good information that you provide. Sounds like I've written this, isn't it? This is a real question, Paul.
You do load questions. I'm positive of it.
No, this is
heavy ego stroking every day I come in.
No, this is absolutely. This is the first time I've read these, by the way. So I get given these from our producer. So we'd like to go freestyle on it and actually straight off the cuff responders to it. So it says, this person writes, the reason I'm reaching out to you is that I am about to sign a contract on a property in Kippering. Here we go. This is your backyard, Paul. You know what's going on there. As I have seen some of the solid fundamentals for growth in the Redcliffe area. Do you think I'm digging my own grave? That's regards Salah Salavand. Salah, thanks for the question. I appreciate your sentiments. It's nice to know that we're adding value to you, and so I do like the feedback, and so does the team. You know, the best feedback we get is to know that we're actually making a difference. So I do appreciate that. But the question here, Paul, is someone's about to sign in Kippering, and Kippering's not far from Redcliffe.
Yep.
Do you think I'm digging my own grave? By investing in Kippering, are you digging your own grave?
Yeah, look, it's I think firstly, it's very nice for you to read stuff that strokes your ego. And look, if I was on the other side,
you can remember
the microphone,
I choose who comes on this show, so just be careful.
I agree. Okay, all right. Look, Kippering. Let's get to the crux of it. I personally see. Look, we go back, disclaimers, it depends on what's in your portfolio. I don't know what else is sitting in Salah's portfolio, but if we look at it in isolation and looking at Kippering as a market in isolation here and now, one thing I'd always want people to know first and foremost in that market is that the Moreton Bay Regional Council government website is always very, very useful when it comes down to information. And places like Kippering, there's plenty of probably aspects within those areas which I'd want you to do. Make sure you've done all your due diligence on in there for a couple of reasons. One of which is most certainly flood overlays. There is certainly some flood mapping in that market there, which you need to make sure you're aware of. There is actually some canals that have been dug and also are in place for things such as stormwater overlays, and they've got some easements that come with those. So I think making sure you know that. Make sure you know your zoning overlays, because there has been some distinct zoning changes right across the Moreton Bay region, but specifically to Kippa-Ring, there's been about probably 120 to 150 particular individual houses which have changed zoning for more density. So depending on what you're buying the property for, if it's owner-occupier, and you've all of a sudden seen changes to zoning, that might well mean that you're going to be seeing 4, 5, 6-story units next to you in the next 10 years. That might not be ideal. Conversely, though, if you're going to be buying it for the intention of development, you might be in a very good position. But I'd know those zoning overlays as well. If you're unsure, give them a call. The council are very receptive of wanting anyone who's looking to invest in their council to make sure you pick their brains. Town planners are on the phone pretty much at any given point in time. Fundamentally, look, one thing with regards to Kippa-Ring, new train station went live there as of October 2016. I was actually chatting to you off air about talking to Anthony Albanese myself 2 or 3 days ago. Very funny anecdotal story of that. We were talking about infrastructure plans for Badgerys Creek in Sydney. He's a shadow infrastructure federal minister, and he actually outlined that he was just talking about some other infrastructure plans that have gone ahead. The Moreton Bay train extension was first tabled to federal parliament, would you believe this, Phil, in 1895.
That 120 years ago.
So this is probably, it's probably a word to the wise for anyone who talks about train lines which have been promised in certain areas and when they start discussion and when they actually happen. And these things actually, they effectively take a long, long time to go through. The good thing about this area is essentially meaning that it has now gone through, it's live, it's active, and there's a lot going on in there. So fundamentally, good population growth. I think jobs creation is something that still has to happen in that region for me to start to see steady uplift in price. It's still very affordable right across that Moreton Bay Peninsula, in particular Kippa-Ring. Rent's still very affordable. You're 30 minutes to CBD, you're about 50 minutes by train, you're about 5 minutes to the waterfront. Again, I think check your zoning overlays, make sure you check your flooding overlays. There's a couple other aspects in there with regards to easements, but fundamentally I'm comfortable with it without obviously knowing the specifics of the address of the property.
So Salar's saying there's a comparison, I guess, with this question between Kippa-Ring and Redcliffe. So she's saying, they're saying Redcliffe's done well, therefore should Kippa-Ring do well. Is that the way it works?
Most certainly not. And I think has Redcliffe done well compared to Kippa-Ring, compared to Newport, compared to Clontarf, compared to Margate, all these surrounding areas of that market. It's done relatively well over the last 5 to 7 years comparatively to Brisbane. If you compare it to Sydney or Melbourne, it's paled in significance. But ultimately, I think if you compare it to a sister suburb, yeah, there might be some flow on. But one thing Redcliffe's got is proximity literally to the waterfront, as well as it's also got the hospital adjacent to Redcliffe itself. It's within 5 to 7 minutes away, but you're obviously seeing price points are significantly higher in parts of Redcliffe. Does that mean you're going to get flow on to Kippa-Ring? Look, to a degree, you might get some creep and you might get a bit of affordability criteria come in there. But I don't think there's enough there to substantiate to say all of a sudden that's gone up 10%, so you're going to get this flow on, because Redcliffe hasn't really done anything astronomical or outside of the norm. So personally, I think it's going to be a steady 5 years in that entire market. I don't think it's going to be insane, but I definitely think that there's good fundamentals. The only real thing I'd probably be concerning myself there with the investor attention in that market, you get seeing rental vacancy rates start to increase a little bit. And we personally, as a company investing in those markets, are probably seeing rents soften a little bit due to investor demand. And obviously what properties were previously owner occupied start to become an investment property. You don't need to develop to increase supply. And that's one thing I think people need to be aware of, is that supply can be increased when you transact an owner-occupied property and turn it into investment property. And that's happened a fair bit right across that market lately. So make sure you do your sums off a relatively soft rental vacancy. That's going to mean that you might factor in 1 or 2 extra weeks of vacancy a year.
So I might get you just explain that a little bit more for everyone tuning in. So what you're saying is that an area that transitions from most of the properties being held by owner-occupiers into investors, with more investors in the market, means that there's more choice for rental properties, and therefore there is less pressure to push up or to even get people into your rental properties, and therefore everything softens quite a lot. So this is a transitioning market really in Kippering right now.
Yeah, I definitely factor that in. And really the way I explain that is, let's say there's 1,000 properties for sale in any particular suburb, and 70% of those were owner-occupiers, 30% were investor properties. If 20% of those, so let's say another 200 of those properties sell to investors, you've all of a sudden got 50% of the stock is now investor stock without building a single property. So ultimately there's 200 extra properties on the rental market as that transition happens. Now, that's not necessarily going to change the demand too much from a price point perspective. In fact, it might mean that you've got more competition for investors and owner-occupiers. So it might put an upward demand on purchase price, but it's probably going to put a softening demand on actual rental, because people will ultimately have more choice, and more choice means more supply, and more supply typically means a softening in price point.
So Kippering essentially it's within the peninsula, right? All service from Anzac Avenue, is that correct?
Yeah,
pretty much
Anzac Avenue pretty much services it right through, all the way from Petrie right along across towards Kippering,
and now
down
there's a train
towards,
line in that it terminates at Kippering.
So I think there's 6 stations between where the Petrie Junction is. That's gone from Kalanga, Marumba Downs, Manga Hill East, Rothwell, Kippering. So you've got those stations that have been included, which are only really live for a year and a half. So you've got the point now where you're seeing people got a commuter belt. They're also going to see some demand come from that Petrie University when that goes in about 3 or 4 years' time, and that's going to increase some more demand.
So do you see many students living in this peninsula, sort of Kippering way?
Definitely not at the moment. I'd say if you canvassed it, you'd be expecting to see very, very low amount of students in general out there. I think that will transition, that will change, and I think the demand for that smaller 1-2 bedroom accommodation over the next 5 to 7 years will definitely change it as well. You've got a couple of hospitals within that peninsula, which will probably put some demand on nurses, potentially wanting to rent in those markets, and anyone in the medico fraternity. But ultimately, it's predominantly owner-occupied.
So what is, sort of extension of this question, why do you see a wholesale shift of a grouping of suburbs go from being not very attractive to investors all over it, and which is what we're seeing? I wouldn't say investors are all over Kippering, but that sort of belt, in through Anzac Avenue. It's affordable. Obviously, there's a new train line going in, so they're following the infrastructure growth. But what is it that presses the button and it just the whole makeup or footprint of an area sort of shifts from being owner-occupied to investors? We saw it at Mount Druitt 5-6 years ago.
Yeah, we're seeing it in Hobart. We're seeing it in Hobart over the last 12 months, where people weren't even looking at it 2 years ago, and all of a sudden everyone can't talk about property unless you're talking about Hobart as part of that mix, and that'll come and go. But really for us, it's never one thing. I think ultimately there's always going to be multiple facets that push a price point from whether it be owner-occupier centric to then therefore investor centric, or a combination of the two. One of the big tipping points lately, I think, and you've mentioned this on your podcast the last few weeks as well, is I think we're now only just in the last probably 6 months in Brisbane in general, probably not specifically to Moreton Bay, but Brisbane in general and southeast Queensland, is we're seeing a big distinct change now in interstate migration. So we're actually seeing physically people starting to shift into that market. So we're seeing confidence that comes with that on the back of jobs creation as well. Brisbane's been talked about for the best part of 5-7 years for investors right across the board, but price growth's been mediocre. House price growth's been okay. Unit price growth, obviously due to the supply issue, has been average. But I think that the population growth, infrastructure, as well as the jobs creation now starts to become a bit more of a crescendo on the back of 2 markets, being Sydney and Melbourne, having a very good, long and strong run, but now starting to taper off. So investors are starting to look at that from an affordability perspective, a cash flow perspective, and saying, well, there is no capital growth coming in those markets for me over the next 3 to 5 years. Cash flow is coming in at 3.5% gross rental yield. Why would I buy there? Attention starts to shift to other markets. So part of it is people looking for value, but the other part is fundamentally owner-occupiers starting to see, well, I can't afford to buy in this market. I can get a job in that market. It's very affordable. I've got good lifestyle, good amenity, etc.
Yeah. The pricing disparity between Sydney and Melbourne versus Brisbane, you're going to see a lot of that interstate migration starting to happen, and CoreLogic recently put out some information. Go and check it out, which gives some insights into that. But I think we've done a reasonable response here, Salah. Your sentiments, Paul? Kippering's not a bad place.
Definitely.
Check it out.
Yep, definitely. Do your due diligence, talk to the council, talk to anyone else who's going to be surrounded in that. Please don't talk to the agents and get their word for it, because look, ultimately they're going to want to sell you what they've got to sell you.
So good basic research. Look at the fundamentals. Right, nice one. Next question says, hi there. Just started listening to your podcast this week, and have to say it's impressive and very easy to understand. Here we go again. This is great. I love stuff like this.
It's because you're a simple person.
Yeah, it's like to make a difference, Paul. My wife and I got married a few months ago and have been madly saving for a house deposit for the last 18 months or so. We're looking to buy a house in the eastern suburbs of Sydney. My wife already has an investment property with her sister. We would ideally like to buy a house sometime this year. Should we buy an investment property first using my half of our savings / shares, or just save to buy a more valuable family house? Many thanks in advance. Kind regards, Simon Street. Simon, thanks for writing into us. Where you are right now, Simon, I think a lot of people have been there at some point in time, looking to, I guess, create a life together with your wife, and all that entails, whether that includes children, all that sort of stuff. And if that's the way you want to go, great, it's cool. You're going to make a choice whether or not you want to have a home, or you want to look at potentially realising your savings by creating an investment. And really, that's a choice that you need to make. It's not one for us to really touch. There is something very emotive about having a home, about starting a new life with someone, about potentially having children and them living within that home, and being a nice, safe, stable place where you can actually build a family. Often property investment all isn't about the numbers. Sometimes you got to follow your heart and your emotion, and you got to follow what's right for you. So, do you want to extend on that a little bit before we actually get into the benefits of investing in a property, Paul, versus a home?
No, look, without going into the detail just yet, but I mean, for me, I think you're exactly right, Phil, is that emotion when buying a home is such a hard thing to curtail. I mean, you rent and you invest. I rent and I invest. And we both have young families. But that's something I think we've probably modified our mindsets pretty early in the piece to be able to do that. And we started investing before we had families.
Yes.
And I think it's tough when you potentially at a different stage in life to maybe think, well, home is where the heart is, and you want to make sure you can anchor yourself to that. So the emotion part is really something that I personally can't answer, you can't answer. And I think they have to really figure out what's important, and is a home the important part? Is it a status part, which I doubt it would be, or is it going to be more what makes sense for us? And we can unpack that.
Yeah, it is. It's a real tough one, Simon. And I look at this, and there's some complexities here because, save. That's cool. I don't know how much money you guys earn and what you can actually dedicate to savings. But buying a house in the eastern suburbs of Sydney.
Yeah, the word there is house, it's not a home, so you can define it straight away, so wipe out. You're not going to get
any change for...
probably two.
So, at best, to actually get in the eastern suburbs for a house, it's $1+ million. So you're going to need a reasonable amount of savings. If you're borrowing at 8%, that's a big chunk of money, and then you've got all your stamp duty or your legals, et cetera, et cetera. So you're going to need a big chunk of cash. And that's cool if you've got the capacity to save. That's great. But to have your money sitting in a savings account right now, at best you might get 1%.
Yeah, maybe 2 if you've got a very happy banker who wants to treat you well.
Yeah, so
that's possible.
Your money's not really working that hard for you if you've got it parked in a bank account. Then there's a level of complexity here also where your wife already has an investment property with her sister. So, there's potentially quite a lot of unrealised equity in that property. I don't know where it is, and I don't know how long they've had it for. So you've got to look at whether or not if you want to move quickly, whether you liquidate that asset and use any proceeds from that to actually add to your savings so you can buy a new house, or you keep that, and maybe you can potentially refinance that and draw some equity out of that and use that as well. So that's probably a question for your bank or your broker, I would say, Paul. It's a tough one, Simon, for us to actually give you advice on this. It's to our original point, it's about the emotional investment you need to make versus a financial investment. If you've got money sitting there right now, you can potentially put that into property, and hopefully if you put into a high growth property, you might be able to realise that increase in equity at a point in time, maybe 1, 2, 3, 4 years time. It's a strategy I follow. I at a point in time will purchase a principal place of residence. It's not ready for me right now, but rather than have my savings sitting in a bank account getting 1 or 2% interest, I've got it working for me in property. So at a point in time, I'll draw down on that equity, and that is what I will use those to be my savings to actually get into a property to buy for the family. You're doing something similar to that, Paul?
Yeah. I mean, I personally been renting or investing and renting, rent vesting, however we want to put it, for a number of years, a decade pretty close to personally, and built a significant portfolio in the background, basically by saying, well, my money can work a lot harder. And at that time, I didn't really know also where and what home would look like. So that's the other part too, is that renting for me is a big try before you buy.
Yeah.
It's a perfect try before you buy, and not just for the property, but it's the location. What's important to you? Is it schools? Is it proximity to transport? Is it proximity to work? All these things come into play. And if you buy, there's a hell of a lot of transaction costs that go with buying. It's very expensive to get in, get out. So unless you're, one of the first things I always look at is, unless you're certain that this is the property, I would probably really consider that part first and foremost before you even talk about numbers.
So outside of that, who else can Simon chat to actually get some advice around this?
Yeah, look, we as a company personally, and I know there's a lot of buyers agencies that I know of who do really good work, that try to unpack these questions probably in a little bit more detail and give some numbers to them. Now, rather than saying this is what you should do, we can lay out some pretty objective numbers to say, well, let's say it's a $2 million house, and let's say at this stage in the Sydney cycle, let's realistically expect the Sydney property market to go relatively sideways for the next 3 to 5 years, somewhere in that shape or form. So if you're putting $2 million worth of debt into something that's going to go sideways, as opposed to renting that equivalent asset, which eastern suburbs will average about 3% gross rental yield on a good day. If you put $2 million, that's about 60 grand a year in rent if you're working off 3%. If your property's going sideways and you've bought it and you're paying, let's say, 4.5% on a principal and interest loan, that's about $90,000 a year it's costing you to hold a property that doesn't go up in value. So I'd look at that there to say straight away, there's $25,000 difference a year that you could otherwise get into another property, much lower price point, whilst renting in that market and testing it. And then effectively, hopefully, with the investments you're going to get out in the side or in the peripherals, getting them working harder than what that property will otherwise do. And one thing I would consider is that if your intention over the long term is to build a investment property portfolio, if you're going to hitch your cart to a big loan for an owner-occupier here and now, good luck trying to get additional cash in the next 3 to 5 years to invest, because you're basically going to become, unless there's going to be significant earnings or a windfall of cash, you're going to become one of those statistics of 82% of people only ever own one investment property. And unfortunately, if you don't pragmatically think about how you're going to access money to keep building your portfolio, that's probably what's going to happen here, as well as the fact that I think your money could work realistically harder as long as you put that money to work in a different market at this stage.
That's good counsel. So what Paul's talking about there is the utility of your money. Yes, you can buy a house in the eastern suburbs. It's probably not going to go up in value, and if it doesn't go up in value, it means you're never going to be able to potentially extract that realised equity gain and put that in investment property, because it's just not going anywhere. And you're talking about a difference of $25,000-$30,000 a year between net interest repayments.
Yep.
And by the way, obviously a question for your accountant, there's no deductibility on interest repayments in a principal place of residence versus something in an investment property. So there are some tax consequences of investing in property. So, why put your money into a property that's not going to go up in value, irrespective of investment property or a principal place of residence? Goes back again to our original comment that, sometimes you got to put other priorities ahead of making money, and if that's living in a nice home in the eastern suburbs with your wife and potentially creating a home for a family, you've got to weigh that up. Absolutely.
I mean, the two things I'd say there is, one is that there's no shortage of houses for rent, and there's no shortage of ways you can negotiate a good lease with a landlord on somewhere where you say, look, I don't want the insecurities, and usually that's the number one issue with people wanting to rent when they've got a family is, can they boot me out? Are they going to not necessarily allow me to be in here for more than 12 months? You can put concessions in place, look at 3-year leases, other options, etc. And the other point I'd make is, it's funny, when we were just talking about that then there, I had a big revelation and said, we were basically in this position in around about 2008, 2009, where we saw this property market in Sydney essentially at the point where it was pretty flat, going sideways, but there were other markets that were moving. And ultimately you do your numbers and say, well, I can buy now, I can get no growth for the next 2 or 3 years, or alternatively, I can get my money working in other markets and come back to the Sydney market when the time's right. And that time was probably more like 2011, 2012, where it started its growth cycle. And there was 3 years in the wilderness ultimately there. And if you go back, there was probably more like 7 to 8 years in the wilderness between about 2004 and 2012, if you factor in inflation. So I think having the right plan and strategy in place here, as well as a fairly good idea of where your numbers are at, you could do a lot. And I think you guys are in a position where ultimately they could
Yeah. Simon, I hope that helps. Let us know how you get on and what you choose to do. And if you and your wife want to come on the show and have a chat about this, you're more than welcome. Just email the team. Same email you contacted before, editor@smartpropertyinvestment.com.au. But good luck. Money doesn't always matter. Sometimes you've got to be happy as well. And if a home is happiness for you guys, you've got to follow that dream. But next question. Stephen Lai. Stephen, thanks for this. It's quite detailed, so bear with me and I'll read it out. But obviously, the front end, Paul, is a little bit of vanity here. Enjoy the content and forum style
common theme
of discussions on your show. Great, thought-provoking. We listen to your show. That's excellent. Thanks, Steve. Mate, it's cool. I like it. It's great. It really makes me happy that people are really that connected and tuning into it. So I appreciate it, Stephen. Thank you. I have some questions regarding the Victorian state government changes to subdivisions. More specifically, the requirement for, inverted commas, garden space. Number one. What's your thoughts on the legislation? A, will this help housing affordability? B, is this state government trying to cool down the property market? C, would such a scheme ever be reversed? Have there been cases of this in the past? D, with a federal election looming, Bill Shorten is proposing of scrapping negative gearing for existing properties. In your view, would this affect your property portfolio? And what kind of impact would it have on cash flow, equity and growth prospects? Okay, so D is a pretty big question in its own right. So let's get to the bottom of that later on. But essentially this question here, Paul's, it's quite micro, and it shows me that Stephen's right in the market he's looking at in terms of all the stuff that you should be looking at when undertaking a subdivision, right? There's a lot of rules and regulations and legislations around it, and it changes depending on where you're doing it,
massively,
whether it's state-based or even local council-based. Every local council's got its own requirements for whether or not you can undertake a subdivision. So wherever you're doing that, Paul mentioned beforehand when we were chatting about Kipper Ring, be tapping into the Moreton Bay Council, actually understanding what their requirements are. So where you're buying down in Victoria, you need to speak to your local council to actually understand whether or not you can actually do a subdivision. But specific question for Stephen here, the Victorian state government changes the subdivisions and green space. What do you know about this?
Yeah, so Daniel Andrews, I think, as part of Labor getting voted in a couple of years back now, they had, which I think is probably somewhat warranted right across the country. I think they had a very good vision for Victoria in general, and probably more specifically the more densely populated areas of Melbourne, to want to see probably something that's going to probably outline a landscape that's going to be not necessarily losing the classic backyard, and seeing a very detailed and I think very much probably a town planner style or a city planner style vision for the city. And as part of that, they changed where the restrictions were on all setbacks as well as minimum requirements for different lands. And ultimately, they wanted to say, well, we know we're getting population growth. We know we want that. We know we want skilled workers to come in here. We've got to house them. However, we don't want to see literally rows of units on every single street corner that's within 500 metres to a tram or train station. So as part of that, what they made the changes to is that I think they put, and I'm going to rattle off some memory stuff here, I think between 400 and 500 square metres, they've got now a minimum garden space of 25%. Between 500 and 650, they've got a minimum garden space of 30%. And between 650 uncapped, they've got a 35% minimum garden space. But they haven't put requirements or minimum land sizes for dwellings. So ultimately, as long as you can fit to the height as well as the minimum garden space requirements, you're going to see more properties go in, but intentionally making sure they've got some green space, they've got some usable outdoor areas, and they're not just concrete jungles. So I think the vision's right. Going on to where that looks, I mean, if we look at the population growth data, Melbourne or Victoria is ultimately going to see around about a population just over 8 million by 2050. We're talking 90,000 people a year going into that city at the moment.
It's got to be the biggest city.
It's going to be, if not
Australia,
equivalent to Sydney, within 30 odd years. So we're seeing that's 90,000 a year, 2.5 people per dwelling. That's about 35 odd thousand new dwellings every year just to meet demand. So if we look at that, we're going to say, well, they've got to house these people somewhere. So that's a given. this is going to happen. So then we've got to say, well, let's do this smart and let's do this in a way that people are going to get really nice and really well accommodating, well amenitied houses, and we're incentivizing people to want to build that. So we don't want to stop them. So yes, it's going to affect supply, but I think it's also going to mean that we're building the right types of properties right across that market. So it's going to give opportunities for developers unequivocally, but it's also going to mean that they're going to have to play within the rules, and they're not just going to create a huge amount of rubbish, probably very quickly put together concrete jungles, as opposed to well thought through, well landscaped and well amenitied, smaller boutique accommodation right across the board. And I think it's a positive thing, and I think it has to happen to make sure we're keeping up with the demand that's coming there. But having some forethought to say we want minimum garden space in all of these lots means every kid that's growing up is going to have something in their backyard, as opposed to just being forced into whatever their parents can afford at the time.
So it's about livability. It is about, and I'm not that familiar with the state government's, the details of their strategy down there in terms of subdivisions or in terms of ongoing development. But state government, local governments don't want to create ghettos. They want to create suburbs, parts of suburbs, which entail or engender family values that create livable spaces for people to live, work, and prosper. The question here, will this help housing affordability? The way in which Australians are living now is very different to how they were doing it 20, 30, 40, 50 years ago. There is now an attitude and aptitude towards inner city living, high-rise living, rather than a quarter-acre block with a picket fence. That's changing quite a lot. A lot of it driven by the diversity of the Australian population. There's quite a lot of migration, and people are bringing those values and the way they live into the Australian context, and that's cultivating a lot of high-rise developments, which is where people want to live. Also, people being single for longer or choosing to be single, families are getting smaller. So we need diversity in the type of dwellings that we have. So will this help housing affordability? I hope the intent is right. The government, whether it's federal, state or local, want to make sure that housing is available to all Australians in some way or another, whether that's the dream of owning the Australian home. But what we're going to have moving forward, generations of renters where renting is only ever going to be the option. So we want to make sure there's property which has rental appeal and is affordable for all Australians. The question here is the state government trying to cool down the property market? I don't think so per se. I think the state government is trying to ensure that there's a diverse property market and there's options for everyone to participate in property, whether it's a place to own or a place to rent. Should such a scheme be reversed, have there ever been case in this past? Nothing is set in stone. Stuff changes all the time.
Definitely.
It can change on a weekly, a monthly or a yearly basis. So irrespective of when you're looking to either secure a property or potentially undertake a subdivision, or if you're looking to purchase a property with the purpose of subdivision in mind, if you did some research 6 months ago, it might be very different than what it is today.
Yeah, I've got an example on that right now on a personal development that I'm doing, where I've recently, probably in November, secured a property actually in Sydney, which was a development site, 1 block, 2 titles, which I'm splitting out and building 4 individual boutique duplexes. Now, it was about 1,190 odd square metre block split into 2, which was just short of 600 square metres per block when I do settle in May. Since then, the government or the local council in which I bought these properties, it was already spoken about before I bought this, but they've actually had pressure. They changed their LEP about 2 years prior to allow no minimum land size for duplexes. And what happened from that is they saw a huge amount of small-time developers putting duplexes into that whole suburb, and ultimately they've had a lot of complaints by local residences, and as a consequence, they've now pushed new legislation to minimise land size to 600 square metres. Now, I'll give that example on mine because I'm doing a subdivision from 600, which is below 600, to what would be now the new minimum of 600. So I'm about 6 square metres off per block, which is a very big expense for me. However, I knew that going in, and this is going to be something that has to be gazetted by state government to be able to come back through and be enforced by the local government area, which is going to take about 12 months. We've already submitted our DA, and we did that intentionally because we knew that this might otherwise change. But you need to be familiar with that, because there's a lot of people in that scenario who potentially have the thought of, I want to buy this, it's 595 square metres, and therefore I'm going to put a duplex and my margins look right, to all of a sudden potentially buying a property which can't have anything done to it. And there might be, in that scenario, that's something that's changed outside of the control of myself or anyone else in that position, where exactly like you said, Phil, you need to know, but you also need to be well in tune of what's going on in that local, state and federal market of what they're intending to do. And that's the part where development looks very glamorous, but there's a lot of people who lose money, mainly for these things. There's a lot of that's out of your control, whether it be local government area, state government, federal government, and also builders and all the variables that go within it.
There's a lot you can control, and what you can control is your knowledge about a particular area, a particular property, to undertake a subdivision. But, the smart investors, I see that go down this path. And we have a number of properties in our portfolio which we've secured on the basis that at a point in time we can potentially do a subdivision. But until we choose to do that, and we might not ever realise that opportunity, as a standalone investment makes sense for us. So we have a fallback position as well.
And that's the key, mate. I think you've touched on that there, is that you can put it in. Look, I was just speaking off air. We're looking at personally buying a self-managed super purchase, which has zoning of 7 stories. Now, it's a self-managed super purchase. I've got 30 years before that's realised if I did want to develop it myself or anything with that. So I'm playing this as a long game. I'm hedging it because I know it's rented and it gets me about 5% now, but you can't bank on this to say this only makes sense because I can develop it, because if that is the case, and unless there's a approved DA on it that you can activate straight away and afford to activate, then you really are taking a huge punt.
Yeah. Doesn't mean anything until you do it. So it goes back to knowing your research. So, and just the last question, Stephen, we're not going to be able to get in detail today. It deserves its own podcast, the one around the federal election looming. Bill Shorten.
We'll get Bill on.
Scrapping negative.
He's keen.
The question is, in your view, this is a apolitical show and we're very bipartisan, Paul. We don't support any particular side of politics. In your view, would this affect your property portfolio, and what kind of impact would that have on cash flow, equity and growth prospects? Well, it'll have a lot of big impact on everything. It'll have a big impact on everyone, the scrapping and negative gearing. That said, we invest in property. We don't consider how it's going to look from a after-tax perspective. When we invest in property, is always before tax. So irrespective of whether or not negative gearing stays or goes, I know our portfolio intimately on a pre-tax perspective, and at pre-tax levels, it still makes sense to me. So if he scraps negative gearing, it's going to change things a little bit. But if negative gearing was to go, I'd see opportunities in the market as well. So, Paul, what do you reckon?
Yeah, I think you're exactly right. I think part of this is I truly personally believe that no one will really know how this will fall if, for whatever reason, negative gearing was scrapped wholly and solely. Now, do I think it's going to be scrapped? No, I think it'll be potentially tinkered with if the Labor government gets voted in within the time frame of the next federal election. But on that, I think your point, Phil, is probably the key point, is that if you're factoring in tax exemptions, negative gearing exemptions, capital gains tax exemptions as part of property making money for you, being able to hold it long term, then I think fundamentally you're going to run into some issues. And we as a company as well at Pure Property don't necessarily ever factor in saying this probably makes sense as long as you can get depreciation, as long as you can negative gear on your salary, because ultimately it's only going to make sense as long as you're earning what you're earning. And that for me is a very, 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 very risky fallback scenario. But if we look at what that's going to change, and let's say negative gearing is scrapped and on all existing properties and unincentivized on new properties, I mean, everyone's going to have a theory. But personally, in my office, our theory, and we talk about this pretty regularly, and we're both part of the PIPA board, and we talk about this from a lobbying of government perspective and trying to give objective opinion on this, is someone's going to have to pay for affordable accommodation. So unless there is going to be ongoing the intention and the ambition and the appetite for state, federal, local, somehow get money going together to keep accommodating this millions and millions and millions of additional people coming to our country living in these city centres, someone has to pay for it. And whether that's new accommodation or whether that's existing accommodation or reconstructing existing accommodation, someone has to be able to create it. So investors at this stage over the last 100-odd years have done a very, very good job of that, and really that is on the backbone of how we accommodate all these additional people that come to this country, and we have to keep doing it.
Spoken like an investor.
Well, spoken like a person who grew up in an area as well as yourself that was on the fringe of Sydney at the time when I grew up, and I saw that was an area that expanded dramatically, but ultimately now it's been changed to units and accommodation around that because there's extremely expensive infrastructure that already exists there. So if you're not going to incentivize an investor to keep these properties and provide accommodation, I just truly don't know where the money's going to be found when you've got an enormous deficit already sitting there.
Yeah, and I think that's good. And my observation towards this, if you're tuning in, is that should there be a change in government, and as we potentially near a an election, just be very careful about the way in which property might be marketed. So number one, if you're getting glossy marketing material which is talking about all the benefits of buying a particular property big after taxes applied, just be very, very careful. There are some certain areas of the property investment market which will promote property post-tax, and my view on this is that look, often people are investing in property that number one probably shouldn't be, or number two could be putting their money more effectively elsewhere. So just be very careful with that. Paul, you agree?
I couldn't agree with you more. When I start to see glossy brochures that talk about tax incentives and everything that comes with that property making sense in an after-tax figure, but it never makes sense to me. And I unfortunately always want to know, ask the question, how is that person getting paid, and how does this make the most sense for my personal position? But
the fact that you're tuning in means that you're trying to educate yourself on property, so you're down the right path. And remember, at the end of the day, we do advocate leaning on some of the very good professionals in this market to support you as you go down the path, but fundamentally you're responsible for what you choose to do in property. So make sure you're informed and educated, and there's no excuse for not being educated this day and age. You've got plenty of podcasts, there's information everywhere. Just ensure that you're relying on the right information. Paul, I don't want to finish on a negative note. It's a bit negative, so let's finish on a positive note. I thought that was pretty
No
good.
negative gearing.
No. Let's keep it, But, it's got to hot up. The whole debate, you're going to see
Absolutely.
plenty of it going on. And, so but we'll leave that for another time. We'll get some people in.
Mate, I think coming close to the election, you're going to see a lot more discussion and hopefully a lot more information about it. But I think it's exciting. It's good to debate it, and I think it's good to discuss the pros and cons of it, because ultimately for me, property is always going to be a money-making vehicle moving forward. There's going to be different ways to make money, and it'll provide different opportunities within the market, irrespective of how it falls. It will always provide opportunity.
And one thing you can bank on in property, Paul, is that property market's always going to change.
Absolutely.
So, nice. All right. Appreciate it, mate. Thanks for your time.
Thanks, Phil.
It was good. Let's do it again soon. And as I mentioned, I'm going to get Paul back in a week or so. It's just a bit of chinwag about what's going on in the market, and do tune in on that. Remember, if you're not yet subscribing to our daily morning market intelligence, all the latest news around property, so you are the first to know what's going on, smartpropertyinvestment.com.au/subscribe. Check it out and let us know what's happening. If you'd like to get your info from social media, Smart Property HQ, you can find us Twitter, Facebook, LinkedIn. Like us, follow us, and please do share as well. One of the greatest way that you can recognise the hard work that we're doing here on Smart Property Investment Show is to tell your friends what we're up to. And if you like what we're doing, please do keep those reviews coming on iTunes. We do appreciate them. 5 stars are great, but leave a comment, because as I've said beforehand, there's a big team behind me and the microphone here who work very hard to get this out into the market. So thanks for joining us on this episode of the Smart Property Investment Show. We'll be back again soon. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.